Over to you, Mr. Adeniyi. Thank you.
All right. Thank you very much, Funmi. And a very warm welcome to you and Mr. Ayode Jebo. Also a very warm welcome to our audience, everybody who is on the call this morning, as we go through what investment advisors do. So this theme is essentially coming from both sessions we've had in the past. You know, the very first and the second, we took some polls and we observed that people's expectations are much more skewed towards knowing more about what investment advisors do. But I really think before we even get there and to our main discussions of the day, it will be nice, it will be appropriate that we take ourselves back a bit, look at the historical development of this function, this particular function in the Nigerian capital market. And there's a reason why I believe we should do this, because a lot of prospective investors out there still ask about what is investment advisory, for how long have we been around, you know, and so on and so forth. So I'll take us back some 40 years back, 40 years because we have a long and very rich, robustly rich history, so that people on this call this morning can actually have the right perspectives to how we came into existence. And along the line also, of course, to bring those memories back more like to reality, I'll be sharing some images of the past. And then that history will throw more light into the whole essence and importance of investment advisory. So let me just quickly share my screen, and then I will take it up from there. Okay, I believe you can see my screen right now. Can somebody help me confirm?
Yes, we can, sir.
Excellent. So you have the history of CIIA. From what you can see on the screen, it all started in 1981 as the Association of Pension Fund and Investment Management, okay? And you begin to see also our founders, and I would say our forefathers as well, and how long everybody has come. With time, because of changes, of course, in the system, that body morphed into what we used to know as Association of Pension Fund of Nigeria. And I think it was at the advent of the pension reform scheme in 2014 thereabout, that strategies also needed to change, and morphed again into what we now know today as IAPM, that is Investment Advisors and Portfolio Managers Association. Again, around 2016, 17, 18, with changes in the market dynamics around the investment world, we had further discussions with the SEC. And in 2018, the CIIA was actually born. So from the slides on the screen, we can see the heavyweights that we like to call today as our founding fathers, the past presidents from 1981. We see the late Dikin Gamaliel Onosode. We see Chief Ajibola Ogunsola, who was president between 2001 and 2003. And that is the very first actually in Nigeria to date. We see late Mr. F.N. Akpe, that is the father of financial planning in Nigeria, whether we like it or not, from 2003 to 2009. Dr. Femi Oyetunji, from 2009 to 2016, who just retired as the group managing director of Continental Insurance. Of course, my very good sister, we call her TFS. She was president from 2016 to 2018. And then since 2018, it's been Prince Abimbola Olasore. So what happened to IAPM? Of course, like I said earlier on, with very robust discussions with the SEC, who saw the need for investment advisors to have a trade group. The CIIA was born, was created out of the IAPM. So today, IAPM has the focus for capacity building, that is training in the area of financial planning, investment management, portfolio management, and all whatnot. So basically, today, IAPM, as you must also have been following, focus on capacity building, while the CIIA is the trade group, official trade group as registered by the SEC of all investment practitioners. So that deals with regulating the practice, okay? So we can see on the screen the launch of the APFIL on 16th of September, 1986. That was 5 years after I was actually set up. You see late Gamale Losode and Chief Ajibola Ogunshola. Of course, I suspect this must have been done in the handover in 2001 at one of our forums. You see the heavyweights that actually were behind this body today and their connections. You see Prince Leko Fadino. For those of us who probably do not know who these people are, you see Otumba Shubomi Balogun, and of course, late Dikin Onosode himself. That's Otumba Shubomi Balogun. This is the 1991 forum of the same Association of Pension Fund and Investment Managers, as it used to be known back then. We have Chief Adetuji, a long-term treasurer of the body, at our 2009 inaugural fellowship induction in Lagos. You see Professor Akintola Bello, former commissioner of finance of local state. You see Mr. Adedishewodu, I think the first Secretary General of the body, and Prince Leko Fadino as well. Prince Leko Fadino, by the way, is one of the very foremost stockbrokers in Nigeria, all right? So that you can see how long we've come. And that is little me and late Mr. Akpe. That was also in 2009. Late Chief Adeoshu, as I think he was the chairman of the occasion. We see Mr. Adedishewo also with his long-term award, more exposures from the event. And our own dear Mr. Tukuru, who was at one point also the executive secretary of the body. He was at one point the chief financial officer, the group chief financial officer of UAC, all right? And then that's Mr. Tukuru 2009. I think he turned 80 last month or so. So you can see our great forefathers. Of course, TFS, who was the president of CIIA, after he was born, created from the IAPM as the first president of CIIA, whom I took over from just last year, October, at an event where we went to honor Papa before he passed on in 2015. I think this must have been 2013, all right? And then the very recent years, the current president, that's Mr. Prince Bimbola Olasore, the former DG of SEC, at a meeting that they had at the inauguration of IAPM then. And then, of course, we give tribute to two of our past presidents who have passed on to the great beyond. And that is late Dikin Onosode and Mr. Akpe. So today, we are bringing this back to us so that we can have a connection, all right, to the development of this trade group official trade group of the capital market. A vision was had and was implemented 40 long years ago. And I believe we have been able to keep that vision alive. But we have now gotten to a point where that vision, the role, the realities need to be deepened. We've had several strategy sessions. I think the most critical one was in 2009, 2010, just after the global financial meltdown. And that was when also the whole global financial market had a major change. We saw this and we knew its importance. And that was essentially also why we said, going forward, there is a gap in the market that needed to be filled. So time has passed. I wouldn't want to waste time on this historical perspective, but it's quite important for us to bring it up. That strategy session defined what we are doing today. So there's a document to it. Of course, it's in our library at the Secretariat, and we are implementing gradually. So what is it that investment advisors do? A lot, but I'll summarize it. For starters, as we go into the full discussion, investment advisors are there to stand in the gap between the buy side of the market and the sell side of the market. They're essentially there to handhold investors who, widely acknowledged, have very limited knowledge in the market. And we all know the market is a slippery one, especially if you are not well versed in what goes on there. Advisors provide guidance, advisors provide protection. So today, when you look at CIA, our objectives, our aspirations, our processes, our code of ethics and standard of professional conduct, everything points to one major important thing: investor protection. And by that, I will leave I will hand over the should I say microphone back to Fumi so that she can lead us into the discussion. Thank you very much.
Thank you so much, our president. For those of us just joining, that's Mr. Akin Adeniyi, the president of Association of Corporate and Individual Investment Advisors. So he just took us through how CAIIA started, and he's shared with us how it was birthed from AIPM, how over time also the presidents have also changed. So straight to why we are here today. Once again, we thank you for joining us. What we have come to do is for you to know more. He told you about how the mandate is investor protection, investor education. So we are here to actually share more about what corporate and individual investment advisors are expected to do for you. So thank you, our president. Before now, we had received some questions, so we'll be going straight to those questions. And please do not forget, the question and answer session is there for you. Kindly feel free to post your questions so that we can ensure that these sessions are taken as expected. So I'll go straight to the question. I hope I didn't lose you. The first question that we got from one of us says, what should a typical investor expect from a registered investment advisor? So like you shared with us, CIIA is a registered trade group with SEC, and therefore investment advisors are expected to register with them. So what really should a typical investor, yourself and myself, expect from a registered investment advisor? As one of discussants, let me start to discuss that. So first of all, an investment advisor holds the fiduciary duty for you, which is an ethical obligation to ensure that he or she with duty of care and loyalty. So having that in mind as an investment advisor that is regulated, what is he then to do to you? An investment advisor is first of all expected to sit with you as the client. Now, why should he or she engage you? It's important to understand your personal and financial goals, especially your long-term wealth building, because investment is a lifestyle. And so the investment advisor must understand these goals of yours. They must discuss these values. They also must then identify the brackets of risk tolerance that you fall in. Are you a conservative risk taker? Do you believe in moderate or quite aggressive? Once the investment advisor understands this bit from you, and all of this are documented, because of the expertise, because of the bouquet of products available to the investment advisor then offers an objective investment advice, guiding you appropriately on the suitable asset allocation that is expected to meet your investment horizon and also fit into your risk bracket. All these advices are ensured they are documented in what is known as an investment policy statement. So as a client of an investment advisor, you must have an investor policy statement, which actually guides the investment advisor on your asset allocation. It guides on your risk tolerance at that particular time. Now, the IPS is just not far away. The investment advisor is also expected, upon the allocation of this asset, to monitor this asset allocation also based on the ups and downs recorded in the market. So the investment advisor will also monitor this. We regularly review your status as it changes. Maybe when you got an investment advisor, you were single, and now you are married with children. Definitely other expenses have come in, education for the children, your cost of living also would go up, and other requirements, building investment towards mortgage and all that. So because your investment advisor is like your lifestyle guardian, the investment advisor will guide you towards updating this status of yours. And therefore, consistently, the investment advisor will guide you through your lifetime and retirement dreams. So an investment advisor is expected to give you optimal support throughout when you are his client. Therefore, we can say that an investment advisor is just like an investment guardian that guides you towards the path to your financial goals. Our president shared with us that an investment advisor is handholding you. An investment advisor will handhold you and ensure that your long-term goals, your short-term goals, your medium-term goals are guided. Your investment policy is being strictly adhered to actually ensure that that big picture you have, that dream you have, that future great retirement plan you have is finally met. Now, I also would allow I don't know if the president will want to say anything around that.
Okay.
Just also to buttress.
Okay, thank you. Thank you very much for that opening enlightenment, particularly on the issue of the IPS. That is one thing that struck me that I really want to pick on and then emphasize. So in a nutshell, as you have said, I want to emphasize it to our audience that when you are working with an investment advisor, of course, this is one of the very important products, all right, that you should expect, all right? That is the IPS, the Investment Policy Statement. It's a very important document that guides the relationship. And I'll quickly just take us to the thrust, what drives the thrust of the CIA operations in the market. We call it STEPS, is an acronym, STEPS. S stands for what? Standardization of processes. So when you are dealing with an advisor, there are standards. You find those standards in our code of ethics. Transparency is the second one. An advisor must not only be transparent, he or she must make full disclosure of how he deals with you. The third one is E, is where we are asking all duly registered advisors to do what? To eschew what we call conflicts of interest, okay? You must always put the investor first. Always put investor first. The investor's interest first and above every other person, including yourself as an advisor. Then P is professionalism. Professionalism. Of course, we've all gone through some academic disciplines, and by the time you are registered by the SEC and you become a member of CIA, we expect you to act according to some standards of what we call standard of professional conduct in black and white, all right? And the final one is S. Of course, as a member of this trade group, there are sanctions where you are found wanting. So our investors also should expect such anytime they are dealing with any of our members. So there you are, and I think you can go on for me. Thank you very much.
Thank you very much, sir, for that contribution. I have another question here that talks about is there really a particular time I must reach out to an investment advisor and not necessarily when I make a wrong decision? So the audience, they're asking, is there a particular time they must reach out to an investment advisor, or is it when they fall into a Ponzi scheme, or when exactly should they do that? I would allow Mr. Abel to take up that. Thank you.
Okay, thank you. Good morning, the President. Good morning, Mrs. Babalola, and morning, the audience. And thanks for having me this morning. That's a very intelligent question. And the way I would like to view this is that investment advisors should be seen like an insurance. Most times we really don't value insurance until when we have problems. The premium that you're supposed to pay sometimes it looks so big until when you have the problem and you now look back and you imagine that you would have paid it. So looking at how advisors should support you, I believe that advisors should support you from when you start saving. You don't want to wait until when you have the problem, because looking at the role investment advisors play, if you recall, based on what the President and also Ms. Babalola said earlier, they are independent. They don't have portfolios, they don't hold shares, so they are just managing you. So the investment advisor would help you carry out due diligence on different companies and determine with you, based on also the IPS, on where you should put your funds. So I believe that investment advisors, you should have investment advisor from the moment you start investing, even before, so that you sit down, you draft that IPS. Is really very critical. And the IPS will be evolving as you grow or as new asset class evolve. Things will change and you may not want to bother yourself with those nitty-gritty. So I would wrap it up here to emphasize that it's not only when you have issues, because you may not be, it's always more difficult to recover. So for those that play like the equities market, when you lose, the ability to recoup those investments is harder than when you are even at break-even point. So most times we don't need to wait until when we have lost fund or you have a very bitter experience about the market. And to just wrap up, if we take ourselves back to 2007, 2008, a lot of people have lost confidence in the market because of how the funds that they lost to the equities market then. But when you also look into details, you will discover that a lot of people were investing into funds, into companies that don't have fundamentals. This could have been prevented by financial investment advisor. It would have been prevented because they will be able to advise you and they'll be able to hold your hands, like the president said, through that journey. Thank you.
Okay, sorry, let me pick on one very excellent point Mr. Ebo raised. Independence. Independence. That is one particular feature that stands investment advisors apart from the rest of capital market operators. That independence allows the advisor to bring objectivity into managing the client. If you are an advisor that is currently working probably in a company, a well-established maybe investment management firm, you discover that you are only able to sell the products of that firm. And in that instance, we say there is no open architecture. But independent advisors, there are actually three different types of advisory model. There is the fully independent, which Mr. Ayodeji raised. There is the, let me call it semi-independent or affiliated. In that situation, you discover that such advisors are voluntarily pulled out from the organization. But for one reason or the other, the organization has said, okay, we don't want you to go. So we'll set you up and then you'll still be our deal pipeline, so to say. So the third one, of course, is where you are fully an employee. So you don't have that independence and you cannot always use your initiative. And this is an interesting area that we want our audience also to take note of, very important note of, because it's a very brilliant career opportunity for people to look at independence, set up your practice, all right? And that is part of the support that we are providing in CIIA for anybody who wants to be a registered investment advisor. So thank you very much, Mr. Ayodeji, for that. I wanted to quickly expatiate on that as we go on. Over to you, Fumi.
Thank you so much, sir. So it seems you've answered one of the questions that we also have received. Going through the chat session, I see Mr. Kehinde Ibrahim saying that your advisor, if not independent, is assumed to be working for an organization, so there should be clarity. And I heard you explain that there are actually three different types. There's the fully independent advisor, there's the semi-independent advisor, and the advisor that works for an organization. So Mr. Kehinde Ibrahim, I'm sure that answers that. Let's go straight into another question that we have received. The question talks about anonymous question, and it says, how do you actually know these advisors that are registered? Is there a directory on CIIA or SEC? Where can one get through to confirm the list of registered advisors? I'll leave that up for Mr. Adeniyi to take that. Thank you.
Okay.
Please feel free to post your questions. Thank you.
Very, very, very important question, and I would say very brilliant as well. So here is how it is. Before you can be a practicing investment advisor in Nigeria, you have to be registered by the SEC. Okay? The SEC has also mandated it an August or September circular of 2015 of the SEC mandated it that every capital market operator must belong to an association, where very many other important issues of regulation will be taken care of. And then, of course, anything above that level will be escalated to the SEC. So first and foremost, registration with the SEC, and then registration with the CIIA. So to now find an advisor, very simple. All you need to do is go to our website, which is ciiang.com. Now, when you get to the member tab, you see it. See, search for members. Now, every member of CIIA means that they are registered with the SEC, and also they are registered with the association. All you need to do is punch in either their registration code or the name, any of the two. Once you do that and you search, it will bring up the detail of the advisor. So I'll use myself as an example. If you go to the website and you punch my registration code, which is CIIA/RC/0007, you will bring up the name of the firm and every other thing that you need. So that is how to validate or get the authentic registered investment advisor in Nigeria. So it's a very simple process. There is a directory to answer the question directly. Over to you, Fumi.
Thank you, Mr. Adeni. I think it might also be good for you to just comment on the fees. So Mr. Kehinde Ibrahim also asked, what fees should they look at, especially looking at how sensitive clients are to fees. Okay. So it would also be good to conclude on that before we move to the next question. Thank you, Mr. Kehinde, for that question.
That's another interesting question, and I'm excited because we are getting the very relevant questions. You know, we have an objective, like I said earlier on, investor protection, and then we are also trying to raise a new generation of investment advisors. The whole idea is to populate that, segment of the market, which is very critical. In 2009, 2010, I want us, when we have the time, to research it very well. That was the major change that occurred in the US market, and advisors took over. So that market, whether you like it or not today, is a buyer's market. That is the same direction that we are headed in Nigeria and with CIIA. So when you become independent or an affiliate, there are about 3 or 4 ways that you can charge your fees, and it's very flexible. So you could charge per hour. You could charge based on commission, that is commission on the products that you sell. And then you could charge on what we call AUM, all right? The fourth one is that you could actually charge a combination of any of the 3. But we encourage that advisors should charge only based on AUM, because it ensures that you are not selling products just to earn commission. In fact, what I advocate is that if you have the cost to sell any product, any commission that you earn on such a product, you should also transfer or pay into the custody account of your client. That is transparency. That is transparency. So if the client believes it's hourly that is favorable, so that means at every point you need to contact the advisor, you set your clock, if it is convenient for both parties. That's why I said this is very flexible. But by and large, the AUM fees model is what we encourage. So if you have a client that on behalf, the portfolio is, say, maybe ₦1 billion, so you will charge a certain percentage. It could range from like 0.5 to as high as 2 or 2.5, okay? So I think the most important thing now is that the advisor is a manager of managers. It is from one source. Interestingly, I was still in discussion with the regulator on this, I think on Tuesday or Wednesday. It is from one source, so that you don't create multiplicity of charges to the client. So once the advisor, places the charge or fee, it is from the same charge that you will pay the portfolio managers. And let us not forget, in Nigeria, the rule, according to the regulator, is that advisors cannot manage portfolios. So you are only holding the client and overseeing his portfolio with the portfolio managers. So that is the way it is done. We call it wrap fees. We call it wrap fees because there will be custodian, there will be the stockbrokers who earn their own commission, even the regulators who take their own commission, stamp duties. So there could be a bundle of fees, but the client is charged only from one source. From one source. That is the way it is done. And it helps to reduce charges, really. It helps to reduce portfolio management costs, expenses to the client at the end of the day. Because the advisor is also to ensure that the expenses are at the barest minimum by power of negotiation. All right.
Thank you, our President. We'll be going to the next question. And the next question talks about, as an investment advisor, what really should the investment advisor be looking at to help to beat inflation in this country, Nigeria, today? I will take that up and then any other discussants can comment on it. So thank you for the question. What you are basically asking is how do you ensure you make as much as the 15.99% of the headline inflation? Now, there is no cast in stone, I must let you know, because as shared earlier, what brackets of risk are you willing to take? There is the conservative investor, there is the moderate investor, there's also the aggressive investor. So if you really are in the conservative bracket, that is your risk tolerance, you are risk averse, you really do not want much risk. I won't say no risk, I would say much risk. You just want to stay with little or no risk. Then you can consider treasury bills. You can consider mutual funds. So you can consider money market investments. Also, you can consider fixed income because basically it gives you periodic returns. So you might want to consider commercial papers, you might want to consider the FGN savings bond or the FGN corporate bond. Also, you might want to consider a dollar denominated fund. So because of your different allocations in all those brackets, you are able to earn a decent return as a conservative investor. For moderates, then you want to take up more risk. That means your risk tolerance is higher than the commercial, the conservative. So you might want to look at, including what the conservative is looking at, you might want to look at exchange traded funds. You might want to then include equities also in your asset classes. You might want to ensure then that the mutual funds you also invest in are example of like an equity focused mutual fund and not only money markets, or a hybrid or a balanced asset class. Now, because your risk is moderate, so you really don't want to take much risk. So you will be relatively careful with your allocation in equities, which definitely is going to be relatively higher than if you are conservative, because you won't even take equity for conservative. For aggressive, then it means you don't mind. You really don't mind to take up risk. So you're looking at a higher allocation in equities. You're also looking at how patient is your capital. So if you have a patient capital, then you are looking at alternative investments. You might look at the traditional one of the real estate. Commodities these days, we talk of gold, we talk of Greek investments. We talk of private equity, we talk of venture capital that is investing in startups. And you also might want to look at, depending on the size and the patience, you might also want to look at hedge funds. Also, you want
Okay.
to consider, really not cast a stone. Hello.
Yes,
Hello, sorry, did you lose me there?
we lost
You
you for
lost
a
me
bit.
for a while. Oh, sorry. So let me backtrack. I stopped at, did you hear my conservative and the moderate?
Yeah.
Okay. So let's start with aggressive. So as an aggressive investor, as aggressive asset class, risk tolerance, I included that apart from what is in conservative and moderate, also then want to look at alternative investments, depending on how patient your capital is. Now, if you have patient capital, you might want to consider investing in startups. These days, we see how fintech are able to raise funds, and interestingly, private equity firms in Nigeria are also pulling funds together. You might also then want to look at commodities, that is gold, agri investments. If also you have a patient capital that is large, you might want to do hedge funds. If also you have, you're looking at trading on commodities exchange, we have the AFX, we have the NCX. We also have REITs, that is real estate investment trusts that are being traded on exchange. So because you have an aggressive asset class, you really don't mind to take a bit of each of it. And also your equities, you'll be looking at foreign and local stocks as well. I said earlier, there is no cast in stone. It depends on how patient your capital is, your risk tolerance, what are you really willing to, how much risk are you willing to take? Now, there's a rule of thumb in investment that talks about the rule of thumb that talks about 100. So it says rule of thumb of 100 that says deduct your age from 100, and that kind of guides you on how risky, the percentage of risky assets you should have. You might want to apply that, but basically it depends on your risk tolerance. It depends on how much you are willing to invest in these different asset classes based on the risk and your ability to take up the risk. Now, the question is, will all this generate the 15.99 you are looking at? Not necessarily, but the risk there is for you not to do anything, because inflation then eats up into the money you have saved, which you haven't invested, because the investment helps it to grow faster. Investment helps it to compound, while savings is just for you to set aside. So will you make the 15.99? Maybe, maybe not. But it is important that you put the savings into investment so that you can at least reduce your negative return. Thank you.
Okay, so quickly, I like the way you have put it. You have emphasized the need for investors to understand two important things: the short end of the market and investing in the long end of the market. I want to believe that this question often comes up because a lot of our investors this side of the world are used to short-term investments. So if you came into the market in a period of high interest rates, you discover that short-term instruments, treasuries, are doing quite well and above inflation. If I recall very well, I think between 2013 and 2016, 17, that was the situation. And a lot of people really must have believed it will continue that way. So investments don't work that way. What you really do have is that all, or let me say most investment products within the short end of the market, that is 0 to 365 days, are actually supposed to command or attract low yields, low return, low interest rate. And as we normally say also, ceteris paribus, all things being equal, okay? Short-term rates are actually supposed to be above the rate of inflation. But in the Nigerian situation, we have it, quite defined or logic. And then where the situation that we refer to as financial depression, where interest rates are below rate of inflation. So ceteris paribus, if you are the short-term investor, risk averse, the best yield that you should be looking for are short-term yields. And we must also understand the difference between hedging inflation, all right, and long-term returns. In the ideal situation, the hedging strategy is cash. Let me repeat that. Ceteris paribus. In a normal situation, the hedge, perfect hedge for your investment is cash. Cash is short-term end. But of course, I know it's the other way around in Nigeria. It is the long-term return that gives you a, should I say, slightly higher assurance that you will beat inflation. So there's a difference between the two. So that's why Funmi has explained it very well. All those alternative asset classes, real estate, hedge funds, private equity, they tend to do well over a long period. They are not hedges for inflation. They are not hedges for inflation. There's more than enough research study that has proven that. Over to you, Funmi.
Thank you so much, sir, for buttressing that the higher the risk, the higher the return.
Absolutely.
So like Mr. Bamidele saying in the chat group, what risk are you willing to take? And the longer you stay in this investment brackets, the higher your probability of earning more than the inflation rate. Thank you. So we also have another question. This question talks about if an investment is given by an investment advisor and it goes wrong, what happens? Does the investment advisor refund me? Do I get a compensation? Who exactly can I escalate this to? I would allow Mr. Denny to start with that, then Mr. Abel might just want to also share one or two things. So who do we go to? Thank you.
Okay. Like I said, there is a procedure. Once you engage your advisor, he takes you through a process. We call it personal and risk profiling. So first thing first, investors must understand that there is something called risk. To put it plainly, the likelihood of you losing money, the likelihood of losing money, it's just natural, all right? And we have just said it already, that if you are not the type of investor who doesn't feel good losing money, there is a general term that we use. We call it the bad times. And this is where the role, one of the things that investment advisors do, become very, very, very paramount. That process that I refer to as personal and risk profiling will bring out, if not everything, most things about the prospective investor. And therefore, it puts the advisor in a situation to understand what we refer to as the bad times. And we all have different bad times. If somebody with 1,000 naira today should lose 10 naira, that is going to be a bad time, or I think. If somebody with 1 billion naira loses 10 naira, I don't think that will be a bad time, or I think. So you see how it becomes more interesting. Therefore, as you approach the market, like we always say also, the psychology of the market is what? Between what? Greed and fear. The investment advisor brings in 4 critical qualities: expertise, objectivity, discipline, and time savings. These are deployed to understand the bad times of the investor. So once that is done, he goes to the IPS, it becomes a basis for the agreement to manage that portfolio. So it does not imply that you will not lose money. There will come a time that your money will go down in value. Markets go in cycles, and that is why we say that you need an advisor who will stay with you. Mr. Adejibo earlier mentioned it that during the 2008-2009 market crash, a lot of people panicked. We call it capitulation. You give up. You just think that, oh, this is the worst. But it is at that time that some people came in and they bought cheap. They waited it out and they made fantastic profit. So what the advisor will do, will make sure that your money, the totality of your money is, allocated in such a way that when your volatile assets go through market cycles, it makes you keep your eyes off that, but there will be enough liquidity for you to weather the storm. So advisors should not expect that they will not lose money. They will lose money at some point, but investors should not expect that they would lose money. That is just a part of investment itself, okay? So let me allow Mr. Ibo also to chip in on that.
Okay, thank you very much, sir. And for me, the way I would see it is that you would have profiled there would have been risk assessment and would have also profiled your investment objective and investment horizon. All those details would have been done, and which would be the major premise for the IPS. So for the advisor, before the advisor would be at fault, first of all, what would be assessed is what was in the IPS. So for instance, if you have in your IPS investment policy statement, if you have that you are totally risk averse and what you want is fully capital preservation, if you don't make money, don't lose money. If you have that stated clearly, and your investment advisor has talked you into investing in equities, then there's something wrong, because you have stated from day one, the investment advisor should know that equities goes up and down. So no matter how interesting or the potential return from equity within that period, but because at the point of engagement, you have stated that you don't take risk. And before this question, we're talking about the risk return. So it means that your risk level would also determine your return, which is critical. And that is why you have some investors, some clients that will tell you, I don't mind, even if it's 2%, but I don't want to lose my capital. So I believe that before it will get into dragging your investment advisor even to the CIIA, and what the CIIA would also look at is what was signed in terms of your profiling. And if there's a total variance, you are not high risk and your investment advisor has taken you to invest in real estate, for instance, in agri, for instance, and you have lost your money totally, it means that there's something wrong at that point. So for me, I won't say that it's a must that you must lose money, depending on your risk profiling. So if I'm going for a fixed income investment strictly, my role would just be to help you in terms of negotiating a better rate than you might have done. I may have access to maybe 10 banks as an investment advisor and have relationship. But for you, you may not even have the time. But I know that what you want is just strictly capital preservation. So if I'm even going into mutual funds, I have to understand the underlying assets of those mutual funds, so that when you need your funds, when you need your funds, your capital will be preserved and there will also be a reasonable return on your investment. Thank you.
Thank you, Mr. Ayodeji, for that addition. Let me go straight to the next question. And I think it's just a fallout also of the one we just answered. So this question talks about what actually is the difference between asset allocation and my portfolio diversification. So we're talking about allocating assets, and now the audience wants to know, how about portfolio diversification? Is there a difference? I think Mr. Ayodeji might be able to take that up.
Okay, thank you very much. Very interesting question. So when we talk about asset allocation, it's the process, an investment strategy, the process of assigning or apportioning the funds across the different asset classes. But in the process of also assigning, you need to take into consideration diversification. So if I've apportioned 30% to equities, even within equities, I need to diversify across sectors. Even within the sector, I need to also diversify. If I'm going into fixed income, we have several fixed income products. Am I well diversified? You know, when we talk about, when you try to normalize, you look at the risk return, you would see that sometimes the equities market can be up while fixed income has a good year. So if your portfolio is well diversified, then the fluctuation will be minimized. The allocation most times is informed based on your profiling. So if you are telling me that, or let's say someone trying to retire at the age of 55 has approached me to advise, you know that at that age you are also tending towards retirement. If I'm going to do asset allocation, it will be skewed more towards fixed income investments to reduce the volatility. But across the fixed income investments, can I diversify across different commercial papers, promissory notes, treasury bills, bonds? I would look at it that it's properly diversified to be able to also optimize the return of the portfolio. Yeah, because to wrap up, yes, sometimes it can be used interchangeably, but there's a bit of difference between asset allocation as well as portfolio diversification. Thank you.
Okay, thank you, Mr. Ayodeji. Quickly, before Fumi goes on to the next question, I just wanted also to speak to diversification, because it's very, very important. And earlier on, I had mentioned one of the things that advisors bring to the table, which is the expertise. It has been shown severally that for a typical investor to get his or her portfolio 90% diversified, you will need between 48 to 50 stocks. I will only use equity as an example. So how many investors really have that time? And security selection is not always an easy thing, all right? You see the advisor with the experience, with the expertise in the area of doing the, I will call it the dirty work. Let me just use that phrase for want of a better one. Crunching the figures, so many processes. Much as I said earlier on that we will not be using too much of investment jargon, optimization, looking for factors and all whatnot in the market. They already have all this information at their fingertips. So they bring in a lot of knowledge into that area. Also, in the area of product design, mutual funds, ETFs, so many others, so that by the time the investing public is made aware of all these things, investors can begin to understand that there's a whole lot of benefits to actually go into the market with or through expert advisors. Thank you.
Thank you. I think you also spoke to one of the questions that talks about the major roles and responsibilities of an advisor. In your last explanation, you picked up major roles, sir. You explained that an investment advisor is a manager of managers, because it's the investment advisor that actually understands your goals, your values, your risk tolerance, and then is able to put all that into context and advise on the asset allocation. An investment advisor also assists for asset allocation. And like you also shared, sir, you mentioned that an advisor helps to product design. That is, for you to stay on your financial course, an advisor understands which products to invest at a particular time, at what time do you review that product and invest into another. Why? Because your liability differs. And so as those liabilities fall due, your advisor that understands your goals will know when such investment should be taken and when you should exit. Just like our president said, in summary, for the role of an advisor is basically helping you to save your time and energy while they handle your investment worries. So that's just a simple role of an advisor. Mr. Ebo already shared with us how see an advisor's fee as you're paying insurance fee, you're paying premium. Yes, everybody knows about insurance, but how many people really take up insurance? But we don't wait for the inevitability. And when it comes with then like, oh, I wish I had saved money. You also can liken it to a gym instructor. So you want to lose weight. A gym instructor kind of guides you on the kind of exercise to do for you to tone your arms, the ones to do for you to lose, body fat. So an investment advisor is quite important in our investment decision. Thank you. Let me go straight to another question, and I will take it 2 in 1 because of our time. So we have Mr. Akinola asking us, how do we become members of CIA? And Mr. Agbola is asking, does CIA even train these investment advisors? So I'll allow Mr. Adeniyi to take that. Thank you.
Okay, thank you very much, Mr. Akinola, you said. Okay, so maybe, he didn't join us when we went through the history and how CIA was actually born out of IAPM. So the answer simply is the first part, how do you join? Of course, we've provided very detailed information on our website. There are basic requirements of qualification. I will share like 2 or 3 with you. Of course, the requisite background, the discipline. Of course, you must have, well, this is still being ironed out, but as of now, the SEC regulation is 60 months, which is 5 years of practical experience, which is not too bad, but we are still trying to propose 48 months. So once you have met those, you can actually register on our website. Okay, you now sign what we call attestation of professional conduct. We want to make sure that there's no criminal record. There are about 6 or 7 questions that you answer. Then once that is completed, you pay your annual dues. And then you become a member. For the training, CIIA is a trade group, okay? It is the parent body, IAPM, that does the training, okay? Let me liken that to the stockbrokers. You have, I think, the CIS, right? Yeah, provides the capacity building. Once you are qualified, you now join Ashon. I hope you understand now. So IPM will train you, financial planning and all that, and then they have a very good affiliation with the CC of the UK. So once you are done with the training, of course, you can register with the SEC. Don't forget, in all this, you can't be a practicing advisor in Nigeria without SEC registration. Please let us always remember this. So that is the way it works. I hope that addresses Mr. Akinola's question.
Thank you, Mr. Adeniyi. So Mr. Akinola and Mr. Gbola's questions have been answered. Let me go to Mr. or Ms. Kende Lamelisa. He or she is asking, is it ideal for an investor to have more than one investment advisor? Say for an investor that has asset classes in more than one countries, would you advise to have more than one investment advisor? I think Mr. Adeniyi or Mr. Ebo can take that up. Thank you.
Let me allow Mr. Ebo to take that.
Okay. Yeah, thanks. So I feel that the first thing to look at is the capacity and the experience of the investment advisor. So if you look at the experience of the investment advisor and it cuts across countries, and also it will also be premised on your asset classes. Is the investment advisor also very vast in these asset classes? So once you're able to ascertain that, I feel that having more than one would, one, be a major cost for you and also cause duplications of efforts. So my advice would be that once you can ascertain that the investment advisor is well versed and understands the major asset classes and also have a little bit of background about those countries that you are trying to invest in or you are also moving the money from, then I feel that there's really no major problem, and by having just one advisor, so that you also don't there's no burden in terms of costs. And also to recall, based on the structure that I understand, when for investment advisor, they are very independent, and your assets most likely would be with the custodian. Mr. Adeniyi would also correct me if I'm wrong, with the custodian. So that investment advisor is going to all the different firms trying to help you do a background check of the products. We'll do the analysis, we'll look at their fees, we'll look at the commission, and we'll profile or we suggest or recommend the best option based on the findings. So even for you, you will jointly take the decision, but you have enough evidence or you have enough details for you to make a decision in terms of the firm. I think when we were discussing with the president, I think earlier this week, he shared an experience of someone trying to invest in Nigeria, and they engaged an investment advisor to help with the background check across the different asset management companies. So what the investment advisor did was to ask the different portfolio managers to submit some basic details. And at the end of the day, this particular client was able to select about 2 and invested in billions into 2 out of about maybe 6 or 7 asset managers that were profiled. So it saves you a lot of time, but the major consideration is the experience of the financial advisor, or I would say investment advisor. Sorry, I'm mixing it up. It's investment advisor. This is different from corporate finance or financial advisory, raising funds. This is more suited, or this is basically investments, investing your money across different asset classes. Thank you.
Very good, very good. Mr. Ebo has delivered a very excellent response to that. And I'm very, very, very happy because he has touched on very vital parts of what goes on. So that to the asker of the question, you don't need to have advisors all over the place. Mr. Ebu mentioned the role of custodian. A very brilliant decision of the SEC, I think the last 1 or 2 months, is that we are going 100% custody in Nigeria. That is a smart move, meaning that all types of products, whether it is individually managed account, separately managed account, or even mutual fund products, everybody should now go custody. So if you are investing all over the world, the major player across different regions will be the custodian, and your advisor knows what to do. But I think in Nigeria, we are still not really warmed up to global diversification. And there are issues around that. Maybe the journey is a bit slow, but we are moving gradually. And I've observed also, the reason probably that informed that type of a question is because the Nigerian market is still a bit obscure to the world. In the last 3 to 4 weeks, like I've been sharing with people from some of the trainings that I've had, there are some statistics that came up that were really very, should I say, heart-rending. I don't want to waste your time. I would have loved to show you the data, but I think I can recall a few of them. The global asset management industry has mutual funds of about 68 trillion US dollars, of which only 808 billion is from Africa. 808 billion is from the whole of Africa. Of the 808 billion, I think we have about 1,732 mutual funds. 1,732 mutual funds. In Nigeria, we have 123 mutual funds. None of those 123 made it into the 1,732. So you can see the challenge. We need to do more. The processes, and that is what we've been advocating also with CIA, the processes will not require you having advisors all over the place. So if we had been doing what other advisors outside of Nigeria have been doing, I can assure you this question probably would never have come up, because we will have been noticed. We will have been noticed. So let me leave it there and go back to Funmi.
Thank you so much, sir, for your inputs. We appreciate that. So I have a question that talks about technology in the role of investment advisory. The question says, how do you see the future of investment advisory in the age of technology? Do you think robo-advisors will outdo traditional human services? I think I can start from that before any one of us takes that up. So yes, there's robo-advisory, which means robots advising people. And I would like us to know that robo-advisory is basically a digital platform powered by technology. So technology in business is just an enabler. It cannot be fully substituted for the human interaction. Now, if you have a robo-advisory, how would the robo-advisory actually understand the full benefits of all what you plan to do, of what your long-term goals are? How will the robo-advisory understand the roles that we said that the investment advisor holds you and takes you towards your full financial dream? Yes, a robo-advisor can advise based on whatever you key in at that point in time, but your situations change, your condition changes, and that is why the IPS is being updated over time. As this IPS are being updated by the human intervention, the robo-advisor, it's actually kept out of that. So yes, in investment advisory, technology is accepted. Technology, we are open to technology. Technology Therefore, it's just a business enabler to us and not a full substitute. So the robo-advisory and human advisory are all in a collaborative effort, all to ensure their client achieves a desired end result. So robo-advisory is just a tool. It's not enough to remove the human intervention. That's what I would like to add. I don't know if we have any input before we.
I will just add one thing to that. Just one thing. Data on human advisory AUM globally and robo-advisors. I was just checking early this morning. So for human advisory, $110 trillion US. For robo-advisory, $760 billion. I think that tells us the whole story.
Thank you, sir. And even in that report, the estimation of the growth of robo-advisory is not as high as the human advisory. Thank you. So let me go to one more question. We would be careful with our time. Like you said, we won't spend more than 1 hour, 30 minutes. But I have Mr. Adeshina Wasiu Adedayo asking. He's saying that his experience over time indicates that only a few percentage of past individual investors have recovered from the 2009 crash experience. So in this light, is there really any substantially tangible way that this body of individual and corporate investment advisors can help to improve investors' education generally? Mr. Adeni can start, and then Mr. Ibo comments on that. Thank you.
I love the question because it speaks to one of the programs of the regulator, Securities and Exchange Commission, through a working committee on financial education and inclusion, I think. And I think my very good friend and sister also, the immediate past president of CIA, is the chairman. That's Tony Sunny. All right. So I will start by saying that, yes, definitely, it's part of our objectives. We'll continue to provide capacity building. And one of the benefits of being a member of CIA is that you will get these, should I say, enlightenment upgrades almost for free, okay? And if you are going to be attending the open courses of IAPM, you can be sure also to get such at a handsome discount. You see, this thing about financial inclusion, there are two things to it. Number one, literacy, education, right? And then consistent counseling. Consistent counseling, because, like I always say, the finance and investment world, I like to believe, is the most dynamic. It changes like every day. New things come up, new financial instruments, new strategies, new methodologies. So we need to keep abreast of this development. And of course, because we're also trying to deepen our market. One of the challenges I've always been thrown, particularly when I do training, is that, you see, Mr. Adedi, you always like to talk about products, but Nigerian investors, they're not really open to all these new ideas of products. But I keep telling them, look, that gap is still there. And the right skills to fill that gap are the advisors. Let's understand one thing. Investment managers, they are not salespeople. They are product creators because they have the skills, the training to churn out new products. And there are two sides to it. There are two sides to it. Product creation and then the investor needs. So we need to match the two. And who does that best? It is the advisor. So to answer his question again directly, we are very much focused on that. It's part of our objective. Also, it's part of the benefit of being a member of the association. And we are committed to it. So our session is quarterly. Of course, this is the very last one for the year. And you can also expect many more of such to come up in the new year by God's grace. So I'll leave it there.
Thank you so much. Okay, Mr.
Just to
Adeni.
also just to add briefly, just investor education is really very critical. And speaking to for still when people still look back to 2007, 2008, to a lot of the losses, most times, based on my little experience when I speak with clients and still make reference to that, is we all go into businesses and they go wrong. What we do most times is to learn from that mistake and to get better at it. And that is where the role of the investment advisor is very prominent, because they will be able to guide you. It's also evolving across the globe because of that word independence. It avoids conflict of interest. You know, like Mr. Adeni cited earlier, we are working with a firm. Most times you would, all the products, it will only be the product of that firm that you be forced to sell to the clients, not minding that there may be other attractive products. But because the individual or the corporate advisor does not have any affiliation, and conflict of interest would have also reduced to a level, you would be able to get the best and optimize your return, and also saves you a lot of time. Thank you.
Thank you, Mr. Adeji. What I would just like to add is you confirmed that an investment advisor helps to manage our emotions. So you're talking of 2008, 2009. How about during the COVID? A lot of people actually sold down in their equity and they felt, you know, the world was going to come to an end. But we all know that from then, of 2020 till now, the equity market has actually picked up and also delivered decent returns for companies with fundamentals. So yes, an investment advisor helps you to understand your emotions and guide you. It lets you know that, don't worry, this too will pass. Don't worry, it's just a cycle in the economy. This cycle will pass. There will be a recession, there will be a boom. So that's part of the role of an investment advisor. Thank you so much, Mr. Ayodeji. We have 5 more minutes to go, but I think we can quickly take Mr. Saeed Bashiru's question. It says, what role does CIA play in deepening this market? Will CIA also get involved in product offering? And how flexible would they be in the regulatory environment? Because it believes that regulations at times stifle progress in this space. Mr. Adeni, you might want to take that up. Thank you.
Okay, all right. Thank you very much. I briefly alluded to that when I gave statistics about, fund products in Nigeria compared to what is actually happening in the whole world. And except we really want to be playing the ostrich, we have to come to terms with the fact that product offerings are not so exciting in Nigeria. And you could, link that to the depth of the market as well. When you look at number of equities listed on the market, I think it's about 168 or there, about 170, less than 200. When you get outside of Nigeria, you see thousands. Mutual funds in the US, like we always like to do in comparison, runs into tens of thousands. And then we have only 123. I looked at equity-based fund in Nigeria, and it comes to 15 billion. I was so alarmed. 15 billion in a country of, like they say, 200 million people. That is not acceptable. So we need to do a lot of engagement with the regulators, because it's not supposed to be a cat and mouse sort of game, that we and them sort of thing. like we all know, operators are always a step or two ahead of regulators. So we need to work together. Quite often what you see is that we talk about the big ideas a lot. We like to talk about big ideas a lot, but the fundamental thing is that we still have to do the little bits. Okay, we want to launch, we have been talking about SPAC now, special purpose acquisition companies. Okay, it's a bright idea. To bring it to Nigeria, there has to be the rules, the regulations, somebody have to write them. Everybody needs to sit around the table and decide what are the rules, what are the do's, what are the don'ts. We're talking about derivatives, if I recall now, for the past, and securities lending for the past 6 to 7 years. But we need to get down. We need to get to the doing. Execution is very important.
Thank you so much.
So that's my take.
Thank you, Mr. Adeniyi, and also Mr. Said Bashiru is appreciating us for this public enlightenment program. And he says that it will advise that there's a webinar calendar. So yes, Mr. Said, it is a quarterly program. I must say that we are committed to investor protection and investor education. We also are committed to increase awareness on the Association of Corporate Individual Investment Advisors. Also, as a group, we believe in advocacy. So we will continue to work with other capital market operators. We will continue to work with regulators, thanks to our SEC that have become so warm with product development and innovation in the market. So we commit that, yes, we will be part of them. Yes, we will enlighten the public more. Yes, we will do more of this training so that people can understand that investments advisory is very important, especially for our future goal, because we all want to live long. And so we can't allow our immediate need to be basically a short-term investment. We need to plan medium, long-term. And we also need a deeper market. And thanks to also NGX for all the webinars and the awareness they also have been doing. So it's a collaborative effort from all capital market operator, and CIA is not left out of this. I think this brings us to the end. It's 12:30 on the dot. As we promised, we said we were not going to take much of your time. And we really would want to appreciate everybody that joined us and waited till the end, and even those that left because of their meetings. Thank you all for joining this town hall meeting fire chat session. Perhaps you have more questions for us. We would like you to feel free to go to our website, www.ciiang.com, to send in your questions or also learn more about us. Thank you all for asking your questions. You all made it lively, and we are happy that we were able to take most of it. Thank you also for joining us. So it's been our pleasure today to host you today. We also have social media handle for the association. Please feel free to use at CIIA Nigeria on Facebook, on IG, on LinkedIn, and please feel free to interact with us more. We thank you all for joining us. I think the president might want to say one or two things in the next 5 seconds, because we have gone 1 minute above. Thank you.
All right, the conversation definitely can continue. Send questions to us at the address that Fumi has just given, and then we'll publicize it. We'll also publicize it. All right. I just want to thank everybody who has been part of this program as we look forward to also host you in the new year. Thank you again, and have a lovely, lovely rest of the day and wonderful weekend. Bye for now.
Thank you, everyone. Thank you, Mr. Adeniyi. Thank you, Mr. Ebo. See you all soonest. Thank you so much. Bye for now.
Bye. Thank you.
Bye.
Okay, Madam Lydia, I think you can stop the recording.
You still have a number of participants. I guess they are taking their time to exit one by one.
Yes. Thank you very much, Fumi. That was a very good one. So that means CIA is owing you and Mr. Ayodeji Ebo a bottle of, is it champagne now or cold water? That was very good. That was very good.
Thank you so much.
That was very good. I see, yeah, I see our council secretary. Mr. Thomas, are you there?
Mr. President, I'm here. Brilliant session, brilliant session.
Good.
Madam Fumi, thank you so much. That was an excellent job.
Mr. Thomas. Thank you.
Very well, ma'am. Very well. And I think Mr. Ebo is off this call. Thank you. That was a good one.
Yeah. Okay. I just noticed that it's out. So that's just it. We will continue the discussion and, of course, the planning for the next one next year, by God's grace. We have a lot of work to do, and by God's grace, we will do it. Let me take my leave now, and I believe it's a good point.
Thank you, everyone. Bye.
Thank you.
Are people asking for the recordings? Are we going to host it anywhere?
Yes, the recordings will be sent to their email.
The link will be sent to the participants.
Those who registered.
Yes, emails.
And they can also find it on YouTube. They can also find us on YouTube.
Yes.
Okay. Thank you so much. Bye. I take my leave.
Well done, Lydia. We'll continue our discussion later, right?
Yes, thank you very much, sir.
All right then.